A lot of us have set goals for this year, myself included. But many homeowners are not taking full advantage of the financial opportunities available through their very own home. That's why I am excited to share all about building home equity and how building equity in a home is a good thing. I will discuss what is equity in a home or home equity definition, building home equity and how to grow it faster, how to use home equity. I'll discuss all these questions right now. Jennifer Yoingco of Texas Home Group. If you are new to my channel, welcome. Make sure to subscribe to my channel and hit the notification bell so you receive up-to-the-minute videos every Tuesday and be part of my insider real estate tips and secrets. As a bonus, watch till the end of the video as I will provide you a PDF version of my discussion today about building home equity guide for homeowners. Okay, we very well know that home ownership offers many advantages over renting, including a stable living environment, predictable monthly payments, and the freedom to make modifications. Neighborhoods with high rates of home ownership have less crime and more civic engagement. Additionally, studies shows that homeowners are happier, healthier than renters, and their children do better in school. But one of the biggest perks of home ownership is the opportunity to build wealth over time. Researchers at the Urban Institute found that home ownership is financially beneficial for most families. But how does purchasing a home help you build wealth? And what steps should you take to maximize the potential of your investment? This is where your home equity comes in. So what is home equity or home equity definition? Home equity is the difference between what your home is worth and the amount you owe on your mortgage. So for example, if your home would currently sell for $250,000 and the remaining balance on your mortgage is $200,000, then you have $50,000 in home equity. $250,000 is the home market value and $200,000 is the mortgage balance. So $50,000 in home equity. The equity in your home is considered a non-liquid asset. It's your money. But rather than sitting in a bank account, it's providing you a place to live and a place to stay. And when you factor in the potential appreciation, an investment in real estate will likely offer a better return than any savings account available today. How does home equity build wealth? A mortgage payment is type of a forced saving for home buyers. When you make a mortgage payment each month, a portion of the money goes towards the interest in your loan and the remaining part goes towards paying off your principal or loan balance. That means the amount of money you owe the bank is reduced every single month. Building equity in a home is a good thing because as your loan balance goes down, your home equity goes up. Additionally, unlike other assets that you borrow money to purchase, the value of your home generally increases or appreciates over time. For example, when you pay off your car loan after, let's say, 5 or 7 years, you will own it outright. But if you try to sell it, the car will be worth much less or depreciated than when you bought it, right? However, when you purchase a home, its value typically rises over time. Again, building equity in a home is a good thing because when you sell it, not only will you have grown your equity through your monthly mortgage payments, but in most cases, your home's market value will be higher than what you originally paid for. And even if you only put down 10% of the time you purchase it, or pay off just a small portion of your mortgage, you get to keep 100% of the property's appreciated value. And that's the wealth building power of real estate. What can I do to building home equity faster? Now that you understand the benefits of building home equity, you may wonder how you can speed up your rate of growth. There are two basic ways to increase the equity in your home. First, pay down your mortgage. We shared earlier that your home's equity goes up as your mortgage balance goes down. So paying down your mortgage is one way to increase the equity in your home. Some homeowners do this by adding a little extra to their payment each month, making one additional mortgage payment per year, or making a lump sum payment when extra money, like example tax refund or an annual bonus or gift or inheritance, comes in. Before making any extra payments, however, be sure to check with your mortgage lender about the specific terms of your loan. Some mortgages have prepayment penalties, and it is also important to ensure that if you do make additional payments, the money will be applied to your loan principal, because you can also assign to escrow, etc. Another option to pay off your mortgage faster is to decrease your amortization period. For example, if you can afford the larger monthly payments, you might consider refinancing from 30 or 25-year mortgage to a 15-year mortgage. Not only will you grow your home equity faster, but you could also save a bundle in interest over the life of your loan. You can also raise your home's market value by boosting the market value of your property, which is another way to grow home equity. While many factors that contribute to your property's appreciation are out of your control, example, demographic trends or the strength of the economy, there are things you can do to increase what it's worth. For example, many homeowners enjoy do-it-yourself projects that can add value at a relatively low cost. Others choose to invest in larger strategic upgrades. Keep in mind, you won't necessarily get back every dollar you invest in your home. In fact, according to Remodeling Magazine's latest cost versus value report, the remodeling project with the highest return on investment is a garage door replacement. Would you believe that? Just a garage door. It's expected to recoup 97.5% at resale, compared to an upscale kitchen remodel. Of course, keeping up with the routine maintenance is the most important thing you can do to protect your property's value. Neglecting to maintain your home structure and systems could have a negative impact on its value, therefore reducing your home equity. So be sure to stay on top of recommended maintenance and repairs. How to use home equity if I need it. When you put your money into a checking or savings account, it's easy to make a withdrawal when needed. However, tapping into your home equity is a little bit more complicated. The primary way homeowners access their equity is by selling their home. Many sellers will use their equity as a down payment on a new home, or some homeowners may choose to downsize and use the equity to supplement their income or retirement savings. But what if you want to access the equity in your home while you're still living in it? Maybe you want to finance a home renovation project, consolidate debt, or pay for college. To do that, you will need to take out a loan using your home equity as collateral. There are several ways to borrow against your home equity, depending on your needs and qualifications. Second mortgage. A second mortgage, also known as home equity loan, is structured similar to a primary mortgage. You borrow a lump sum amount which you are responsible for paying back with interest over a set period of time. Most second mortgages have a fixed interest rate and the borrower with a predictable monthly payment. Keep in mind, if you take out a home equity loan, you will be making monthly payments on both your primary loan and your secondary mortgage. So budget accordingly. Next is cash out refinance. With cash out refinance, you refinance your primary mortgage for a higher amount than you currently owe. Then you pay your original mortgage and you keep the difference as cash. This option may be preferable to a second mortgage if you have a higher interest rate on your current mortgage or prefer to make just one monthly payment. We also have the Home Equity Line of Credit, or HELOC for short. It is a revolving line of credit similar to a credit card. It allows you to draw out money as you need instead of taking out a lump sum all at once. A HELOC may come with a checkbook or a debit card to enable easy access to funds. You will only need to make payments on the amount of money that has been drawn, similar to a credit card. The interest rate on a HELOC is also variable, so your payment each month could fluctuate depending on how much you borrow and how interest rates are. Another thing is reverse mortgage. A reverse mortgage enables qualifying seniors to borrow against the equity in their home to supplement their retirement funds. In most cases, the loan plus interest doesn't need to be repaid until the homeowners sell, move, or is deceased. Tapping into your home equity may be a good option for some homeowners, but it's important to do your research first. In most cases, another type of financing or loan method may offer a lower interest rate or better terms to fit your needs. And it's important to remember that defaulting on a home equity loan could result in foreclosure. Ask us for a referral to a lender or financial advisor to find out if a home equity loan is right for you. And by the way, a disclaimer that the above references is an opinion and is for informational purposes only. Seek financial advice or consult a professional for advice regarding your individual needs. I hope you have enjoyed and learned in this video. Be sure to scroll down in my description to get a bonus copy of my Building Home Equity Guide for Homeowners. And don't forget to subscribe, like, and comment below with questions. Again, this is Jennifer Yoingco. You are my priority for anything real estate, serving Houston, Tomball Spring, and the surrounding cities. I'll see you next Tuesday. Bye!